Welcome to the deep dive. Today, we're going to skip the punditry, skip the headlines, and walk straight onto the trading desk of a senior portfolio manager. Because if you really want to understand capital markets, you have to look past the surface level price action. You need to understand the actual plumbing.
That's exactly right. And our mission in this deep dive is really to extract that institutional framework.
So the playbook.
The playbook, yeah. The exact process that world-class strategists use to decode liquidity, to find true capital flows, and to understand volatility dynamics. We're looking at the critical indicators they would reviewed leading into, say, Monday, December 8, 2025.
All to decide if the recent market moves were genuine, if they were sustainable, or if they were just noise.
That's head fakes, yeah.
Yeah.
Designed to confuse retail traders.
Okay, let's unpack this framework then. I want to start with the most immediate read, the closing bell. For institutional players, that final hour, the power hour as they call it, is often the most revealing part of the day.
It really is.
So how do they distinguish genuine institutional positioning from just, some flimsy end-of-day momentum?
Well, it all comes down to the confluence of price and volume, specifically in those final 30 to 60 minutes of trading.
Okay.
We define what we call institutional accumulation as indices like the S&P 500 or the NASDAQ 100 printing near their daily highs. But, and this is the key, coupled with a significant expansion in volume right into that final minute.
So the PM sees that big rush of volume at the highs, and that tells them it's high conviction. It means large players are willing to pay up because they think the rally has legs.
Precisely. They are actively positioning into strength.
Yeah.
And conversely, you get institutional distribution.
Which is the opposite.
Exactly. That's flagged when prices start to weaken or they just struggle to hold those daily highs, especially if that weakness comes with sharp, heavy volume selling in the final moments.
So that signals that the big money is de-risking. They're using the market's strength as an
exit ramp.
Yeah.
Perfectly put. They're using that liquidity to get out.
Now let's talk about the most common, deceit signal. This volume price discrepancy. We see it all the time. The market index just climbing on what seems like thin air. If prices are rallying, but the volume is actually declining or just stagnant, what does that instantly tell you?
It tells you the move lacks any real institutional sponsorship. It's hollow.
Okay.
If a rally is starved of expanding volume, it's usually just short covering. It's a technical thing fueled by traders getting squeezed, not genuine new capital flowing in. And if there's no institutional commitment, that rally is incredibly vulnerable.
And this feeds right into that idea of a market head fake, right? The close looks great on the screen, but then you see it immediately reverse in the after-hours session.
And that reversal often confirms it. It confirms institutions use that late-day technical push just to distribute their shares quietly. We actually use something called a liquidity check to spot this vulnerability ahead of time.
How does that work?
First, by monitoring the depth of book, or the DBB. If you look at the bid and the ask stacks in the major underlying stocks, and you see those stacks are thinning out on a price move up, you should be worried.
Because if the depth of book is thin, that means there are no standing orders there. There's no structural support under that rally.
Exactly. Think of it like a bridge, where the structural supports are just eroding away. Any significant selling pressure, even a single large block trade, is going to have an outsized impact on the price.
It could trigger a collapse.
It could. And second, we look at the cost of doing business, spread widening. If the bid-ask spreads widen significantly under pressure, liquidity is drying up. It's becoming prohibitively expensive for an institution to execute a large order without, driving the price against themselves.
And that's a huge red flag for volatility ahead.
A huge one.
Okay, so if the closing price gives us that immediate read on institutional intent, we need to zoom out a bit and look at the market's vital signs. This is where we shift from that microstructure to more of a systemic health view. And nothing reveals the systemic health like volatility analysis, specifically the VIX term structure. Why is the curve itself so much more insightful than just the headline VIX number we see on the news?
Well, the VIX headline, that's backward-looking. It's historical. The term structure, on the other hand, is pure risk expectation.
It's forward-looking.
It's entirely forward-looking. It tells us when the market expects stress. Are institutions buying protection for next week or for 3 months from now? It's a barometer of fear perception over time.
So let's quickly define the two key states. The baseline, the normal state, is Contango.
Right, Contango. That just means longer-dated VIX futures are priced higher than the shorter-dated ones. It signals complacency, stability. The market basically expects volatility to settle down over time. It's a positive environment where Short volatility strategies tend to do very well.
And the opposite, the big stress signal, is backwardation.
That's the inverted curve. Near-term volatility is suddenly more expensive than long-term volatility. It signals immediate market stress, even panic. It's a rush for short-term hedging, and it really only surfaces during those sharp structural sell-offs.
So what's the more subtle warning sign? The one a portfolio manager is looking for even if the headline VIX is still pretty moderate or low.
A flattening of that curve while it's still in contango, that tight compression you see between the front month and the next month, that indicates rising near-term anxiety.
Oh, okay.
The demand for immediate hedging is picking up fast. Even if the general market is still sort of floating higher, it's often the silent precursor to a full backwardation event.
So we've looked at fear. Now let's look at participation. That brings us to market breadth. We need to know if all the boats are rising or if the index is just being carried by a handful of massive tech companies.
And that's where the advanced decline line, the ADL, becomes so crucial. A rising ADL, one that confirms the rally, shows broad participation. Most stocks are moving higher together. But the danger signal is a persistent divergence.
Meaning the S&P 500 is hitting a new high, but the ADL is actually lagging or even declining. The majority of stocks aren't participating.
Exactly. And that signals a really dangerous narrow rally.
Yeah.
You're exposed to single stock risk rather than a healthy cyclical upswing. We also monitor things like the percentage of stocks above key moving averages, say the 50-day.
Right.
If that percentage is trending down while the index itself is trending up, you know the underlying health of the portfolio is deteriorating. That lack of synchronization suggests a vulnerability that a short seller could absolutely exploit.
Okay, let's go even deeper now into the capital flows the public doesn't see. Dark pool signatures. These are private exchanges where institutions execute those huge block trades anonymously. What insight can we possibly get from something that's, by definition, opaque?
We're hunting for hidden conviction. A key indicator here is something called the Dark Pool Index, or DIX. If the DIX is reading positive, which means the S&P 500 is trading at a systematically higher price in the dark pools than on public exchanges, it suggests something very important.
It suggests large, sophisticated buyers are quietly accumulating shares off-market.
Yes, we see that positive conviction, that accumulation happening behind the scenes away from the public eye. And that's a very strong signal of genuine institutional confidence, regardless of what the headline volumes might look like.
It's a validation of where they think prices are headed.
It is. Now, finally, we have to monitor correlation breakdowns. The most vital relationship for any risk manager is the equity-bond correlation. Traditionally, bonds are your counterweight. They rally during an equity sell-off, offering that diversification.
And when that relationship breaks down?
When bonds fail to rally during a correction, or worse, they sell off with equities. That's a red flare. It signals heightened systemic risk.
Because the key diversification benefit is just gone.
It's gone. It means institutions are de-risking across all asset classes. It suggests a really deep, widespread fear about future liquidity or maybe inflation risk.
That analysis really sets the table perfectly for the most advanced part of this, finding those asymmetric risk-reward opportunities for the next session. So how does a portfolio manager define and then hunt for that asymmetry, that convexity in the market?
We're hunting for trades where the potential upside massively outweighs the possible downside. We're seeking convexity, a small, well-defined risk that can lead to a disproportionately large sort of exponential gain. The strategy isn't just about predicting direction. It's about finding where the market's plummeting is set up to reward an outsized move.
And the first step in that hunt involves mapping the market's true mechanical points, the liquidity pockets.
Exactly. We identify major support and resistance levels. These are price points where you can see institutional buy and sell orders are just clustered together. They're like the market's gravity wells. Breaching these levels is critical because it can trigger massive cascading stop-loss orders.
And that brings us to the targeted price action that so many retail traders fear, but that institutions actually anticipate. The liquidity sweep, the so-called stop hunt.
Yeah, and markets move with incredible efficiency to take out those stops. A liquidity sweep is when the price briefly overshoots a recent swing high or a low, just enough to trigger all those stop-loss orders, and then it immediately reverses.
And you're not participating in the panic?
No, we are using that predictable shakeout as our entry signal for the bounce. It offers an absolutely excellent asymmetric entry point.
Okay, let's move to the most complex piece of this, of the market microstructure. Gamma dynamics. You've called this the market maker's accelerator or dampener. So gamma isn't just about price movement. It's an invisible feedback loop. It tells us if market makers are stabilizing things or actively creating chaos.
That is the perfect way to frame it. Options dealers have to hedge the risk from all the options they sell. That hedging creates this dynamic force in the market. The gamma flip point, or the zero gamma level, is the pivotal price where this aggregate hedging behavior transitions from being a stabilizing force to an amplifying one. It's the single most important volatility constraint to watch.
Let's break down the two regimes then, based on that point. What happens when the index is trading above the flip point in so-called positive gamma?
In that environment, the dealers act as a dampener. They've sold more calls than puts, or their overall book just requires them to stay delta neutral by buying the dips and selling the rallies.
Which kills momentum.
It kills momentum, it creates mean reversion, it compresses volatility, and it makes any sustained directional move extremely difficult. It's a very stable, some would say boring market.
And what if the market breaches that level and stays below the flip point? In negative gamma, this is where the asymmetric setup often appears.
Absolutely. This is where volatility explodes.
Mm.
Here, dealers are forced to act as an accelerator of volatility. They have to sell into weakness to hedge their put-heavy books, and they have to buy into strength.
A vicious cycle.
It's a vicious positive feedback loop that amplifies every price swing. It creates those sharp drops and parabolic spikes. And that environment creates the ideal conditions for an outsized directional move, that high convexity setup we are hunting for.
It sounds like the gamma flip point is the steering wheel. It determines if the market is going to glide smoothly or suddenly just lock up and lead to these sharp overcorrections.
It is precisely that structural constraint. And finally, we look at specific options-related liquidity levels, the walls. We track put walls and call walls. These are just large concentrations of open interest at specific strike prices.
And these act as magnets or resistance points?
They absolutely do. Because of all the hedging activity required by dealers, especially near an options expiration, these walls become temporary support or resistance levels. PMs track them very closely because they define the immediate targets the market is likely to pin to.
Or if they're breached.
Or if they're breached, they define the start of the next explosive directional move.
So what does this all mean for you, the learner? Institutional market analysis isn't about any single metric. It's about synthesizing the confluence of volume, breadth, liquidity, and these volatility dynamics to manage a portfolio effectively.
Yeah, the goal is to move beyond just forecasting direction and instead identify situations where the plumbing of the market, that order flow, those hedging pressures, is set up to reward a favorable skew in potential outcomes. That convexity, where your risk is defined and the potential reward is exponential, that's really the essence of world-class strategy.
We've shown that the market's behavior is so often determined by this invisible plumbing, not just the headlines you read. So for your continued exploration, consider this. How closely does the VIX term structure align with the gamma flip point in historical periods of volatility? Does one of them consistently precede the other in signaling market stress, maybe allowing you to anticipate the moment volatility transitions from a dampener to an accelerator?